Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to the Live Life Liberated podcast. I'm Wendy McConnell. Today we have Chris Hyman and Sean Clark. Hey, Chris, how you doing?
Hi, Wendy. I'm doing great. How are you doing?
Oh, I'm good. We're looking forward to spring at this point, right?
Oh yeah. Once February comes around, I'm always in the doldrums. So, I'm on the East Coast where we have four seasons. My colleague Sean, he's actually in Southern California. Been quite rainy there recent, but they experience a little bit better weather. So I don't know if he quite has the winter doldrums, but I certainly have them. So
All right. What do you think, Sean?
Yeah, it's all relative. I mean, out here in San Diego, 50 degrees may as well be 20 below in other places of the country. So, we get a little rain out here. We're not so happy. And I don't know. So we're in the winter doldrums too, Chris, just a little different. It's all relative, but.
All right. So what do we got on tap for today, guys?
Yes, thank you. Well, today, let me give a little quick. For those of you that are not familiar, I'm the director of insurance here at Centura Wealth Advisory, and director of insurance solutions to be exact. And I help create and model out tailor-made life insurance solutions for our clients, many of which who we take through comprehensive planning engagements to really provide a lot of tax planning, wealth transfer tax planning. We do, we really look at their whole picture. And many times I'm working with my colleague here and our guest on the show here, Sean Clark, who's a wealth advisor here at Centura. We're, synergistically working together with these different planning strategies. And today we're going to talk about one of those planning strategies in particular, who we really cater towards our business owner clients. We're typically dealing with two types of clients here, where we're focusing on. One is C-suite level executives, and the other is founder-led business owners. Typically, in the range of making north of 2 million in annual income, typically net worths of 20 million or greater. So Sean, that being said, the strategy we're focusing on today is a type of qualified plan, and it's a type of qualified plan that's sort of supercharged relative to other types of qualified plans. So all that said, can you please explain to the audience today what this is, what we're going to be discussing, and who is it catered for? Who does it suit?
Yeah, so what we're going to talk about is retirement plans. And there's a lot of different ways of saving for retirement, right? There's IRAs, 401ks, things of that nature. And I think a lot of our listeners are probably familiar with that. We've got other podcasts on what qualified plans are and things of that nature, but it's any pre-tax retirement savings. So it's putting money away into a retirement account today, not paying tax on that amount today, and instead you pay tax on when you pull it out as income. So that's the general idea. And specifically what we're going to be talking about today is how business owners who are making a lot of money can put away far more than they can in traditional plans and other areas or methods that they're probably familiar with. So we're talking, millions of dollars of deferred, being able to defer millions of dollars of taxes and put that away in a pre-tax manner. So it's a unique strategy. We're talking about qualified plans, just like everyone knows, but in a very unique way for business owners. And I think that's important to highlight because we're going to dig into some of the specifics. So if you're not a business owner, you don't have a ton of excess cash flow, this topic might not be for you. But if that is who you are, then you should listen.
Okay. Perfect. I'm really excited to get into this topic with you and explain how it can be valuable and in what circumstances it can add value. So you mentioned there, this is a type of qualified plan, but obviously there's other types of qualified plans that business owners can utilize. So can you talk to me a bit about what are some of those other types of plans? And then talk to me about really the difference between a defined contribution plan and a defined benefit plan. Because a lot of times business owners utilize the former and not so much the latter. So
let's just boil it down kind of simple for listeners. But if you're just starting out a business, for example, and you want to set aside money, the method you might use is an IRA, and you might be able to put away $6,000 or so. And, that's great for while you're getting started. But as you start making more money, or maybe you get some employees, you want to be able to contribute more. So you might set up a 401k plan. If you start exceeding, and that might get you up to, 20,000, that area, depending on your age and stuff. But let's just call it $20,000 for rough math. And then if you get higher than that, you can get into things like a SEP IRA where you're in the area of like 50 grand or so. So, these are smaller contribution levels, but there are various plans with different limits, and the IRS sets those limits, and there's different parameters of when they're appropriate and why and all that kind of stuff. But generally speaking, somebody who's starting out a business will start with a small, simple, inexpensive plan, maybe an IRA and then a self-employed 401k. Maybe they then get into a SEP IRA or something like this. They start adding employees, and then they switch to a 401k plan or something like that so that everybody can participate in a different way. And that's where I think a lot of the business owners kind of get to. And once you're at that point, you've got a good amount going towards retirement each and every year. That, I think, is the evolution for most people, business owners or typical W-2 employees as well. They might not have a SEP IRA or solo 401k, but even W-2 employees can contribute to 401ks. So those limits are kind of the same. And those are called defined contribution plans. So a defined contribution plan, which was the other part of your question, is where employees or the employer can make contributions to a plan or to an account based on what they want. So it's a defined contribution. There's limits, there's kind of a methodology around that. And that differs from a defined benefit plan, where a defined benefit plan has stated benefits that would be paid or applicable to vested employees. So there's a covered group of employees, and if they vest in the requirements that are there of the plan, then there's some future benefit that they're entitled to. So pensions are a good example as a defined benefit plan. 401ks are a good example as a defined contribution plan. And I think those are things that most listeners are familiar with. I mean, if you're a business owner, you've probably dabbled in self-employed 401ks or SEP IRAs and those kinds of things. Maybe even you've looked at a defined benefit plan or heard of it. And some of our clients come to us with defined benefit plans. So I think it's important to just kind of tee up that we're going to be talking about a slightly different version of a defined benefit plan. But hopefully that answers your question, Chris, in terms of what the
and so it seems to me it absolutely does. And thank you for that distinction there. It seems to me with the defined contribution plan, sort of the risks in terms of the performance of the underlying plan assets and what's ultimately going to be paid out lies with the employee, right? Lies with the participants. Whereas in a defined benefit plan, it's the actual benefit is more defined, right? So it's really the risk is not necessarily, it's more on the employer to then be able to produce that accrued benefit. Am I correct in that?
Yeah. So just to make it simple, if I'm in a plan and I want to contribute 10% of my pay to a 401k as an example, or up to the maximum, that's going to be some stated percentage, right? That's a contribution that I put in. I'm going to be able to control those investments. It's effectively a segregated account that if I left and I'm vested and able to, I can move that account, or, it's for my benefit kind of thing. So those are defined contributions where it's set on what I can contribute in, and then what it earns and what it does is up to the investment decisions and performance thereafter. But it's the contributions that are defined in terms of what I'm allowed and permitted to put in.
Right. And that's why these defined benefit plans can be so powerful, right? Is because the contribution's not necessarily defined. It's more of a I guess, end result of kind of the guidelines and parameters surrounding the benefit. So I guess let's focus on that. So is there a limit on the contribution, or how ramped up can we get these? I mean, perhaps I know I like numbers and our listeners like numbers. Maybe take me through what's the typical amount that business owners could put away in these plans, because you're obviously capped on, defined contribution plans, maybe at $70K a year, all in, if you're looking at the employer contribution plus the, employee contribution, maybe a little bit more if you're closer to retirement. But what are some of these levels with these defined benefit plans we're talking about? How ramped up can we get these contributions?
Okay. Yeah. Let's talk about that. Before we jump into that, let me just so a defined benefit plan, we talked about the defined contribution in terms of it matters on what you're putting in and how it grows. The defined benefit, to your point, is based more on some vesting requirements like years of service. So if you're a covered employee, we'll talk more about that. But if you're a covered employee in here and you meet the vesting requirements, then you get some stated benefit. So I think a lot of our listeners might be familiar with like pensions or those kinds of things where you work for X number of years, you satisfy the vesting requirements, and you get a pension of Y amount starting at age Z, right? So I think those are standard ways where defined benefit plans are applicable, and many people are familiar with it, but that's the difference. So you meet a set criteria, and then there's some benefit to you, versus a defined contribution. You're putting money in on your own choice based on what amounts are permitted, and then making choices on investments and things thereafter. So there's a slight difference as the participant in terms of what you're doing. But even in a defined benefit plan, there are contributions. Those are made by the employer, to your point. And so it's a little bit different when we separate employers from covered employees. So typically we set these defined benefit plans up for the benefit of the employer, right? The owner of the business, or a select group of employees. So that's the first thing. There's a discrimination kind of process where we collect a census and go through who's a covered employee and make those definitions and parameters. Then that subgroup will go into an actuarial analysis on the business and on those participants to determine what the contributions could look like. Those contributions will have a range from a minimum to a maximum, and there might be a target in between. And we'll get more into the details of it, but those get determined by an actuary, and those get provided to the employer, the business owner. And the owner is responsible for making the entirety of these contributions for the defined benefit portion. So the employee, if you're a covered employee, you're not obligated to put any money in on the defined benefit side. The employer funds that. And if you as the employee meet the vesting requirements, you'll meet those benefit requirements later on. But if you left and didn't meet those vesting requirements, then those are plan assets, and then they'd revert to the owner there. So this is really set up for the owner's benefit. And that's why we're talking about it for business owners, right? Most people that come to us want to set this up for their benefit. And the goal is, hey, how much can I put away? So as part of that design process, what we're talking about, just to give context, that I'm working on I work on these all the time and with you. And a current case that's come in through us is contributing, the maximum I think is 2.8 million that they can put in, and they're contributing about 1.8 based on their cash flow. So the max they could put in is 2.8. The minimum is much less than that. I forget what it is, a couple $100,000. But where they want to put it in is based on what their cash flow is. And I think that's something we'll talk about next is, how do you determine what amount to put in and how this works? But to answer the question around what the contribution thresholds look like and where those could be, I mean, we're talking, 10x, 20x, 30x, what you can put into other plans. So we're talking the ability to defer millions of dollars if facts and circumstances are correct.
Yeah, I think you hit the nail on the head there. I think so. So it sounds to me as though the facts and the circumstances surrounding, the ultimate benefits that are going to be provided can really lend itself to a very high contribution. There's really no IRS stated contribution limit. It's working off of, I guess, the employee census and the actual circumstances of the case to determine, hey, what's the maximum that we can contribute here to end up meeting these these benefits down the line. Wow.
Yeah, and that's not. I think it's important. Like, there's a lot of setup here and work, right? These things cost tens of thousands of dollars to get set up and administer and those kinds of things. So it's not a free lunch here. You can't walk into your local, investment shop and open up one of these kinds of plans. So we'll talk a little bit more in terms of the marketplace and, why these are underrepresented and stuff like that. But I think it's important to just note that this is a very unique way of going through it. It's not just an off-the-shelf product. So it's important for, different considerations to be put to play in order to make sure that it's the right fit and stuff.
Yeah, absolutely. Absolutely. And obviously we take our clients through, through that process and, determine if this makes sense. Okay, well, look, I'm no Euclid, right? I'm no math expert, but 1.8 million sounds, a far cry away from, 70,000 in terms of. So it seems like you can really get a lot of contribution into these. So take me through. All right, so we have a business owner. This could be a good strategy to, stack away more, a lot more in pre-tax dollars. But take me through what is this usually applicable, right? We're gonna take our clients through this process to make, to see if this is potentially valuable strategy. In what circumstances, right? Like what are the factors that business, or what's the criteria that business needs to meet in order to be able to implement this plan or for this to make sense?
Okay. Well, first off, I think you earned yourself a new nickname there, Euclid. So we'll call you that from here forward. But I think where this makes sense is from a surplus cash flow standpoint. So if you find yourself as a business owner with extra money coming in that you're going to pay tax on, then this is appropriate. because any surplus cash flow that you have is going to be taxed, right? And if you're in a high marginal tax rate, if you're making the kinds of money, the type of money that we're talking about here, that could be 50% or so. So when you're into that kind of a tax bracket, that's a big haircut on your wealth. And that creates the incentive, I guess, to put away money to basically create a deduction and mitigate what your taxable income is. So that will basically shave off from the top down at the marginal rate. So any money you put into these plans is going to be saving maybe 50 cents on the dollar here in California. And you're able to kind of put that in and defer it and pick up 3/4 of the benefit or more. There's a lot of math that goes into that, and we can talk more about the design and things. But I think that's the overall fact pattern of when it's appropriate. Because if you have surplus cash flow that you're going to pay tax on, the question is, do I want to pay tax now and then invest it? Or do I want to defer that, put it away pre-tax now and pay tax on it later, right? And that's just like a Roth IRA versus a traditional IRA. You have that choice that exists in different ways, but this is the same example. And so I think if you feel like there may be a lower tax bracket in the future, or you may have diversified wealth where you can control the flavors of income you have, those are all fact patterns that will lend themselves to creating value in the optionality of deferral. So that's a bit of a mouthful there, but I think that's really what's going on here. Okay.
And now talk to me about the census, so to speak, in terms of, and going back to that example, the 1.8 million, I know many times we're trying to structure these plans so that the bulk of the contribution allocation is towards the business owners or towards key employees. I guess talk to me, what's the optimal kind of employee-based structure for this to make sense? I mean, are we trying to do these on, companies where they're, businesses where they have a lot of employees or a lot of younger employees, or what do you see as sort of the optimal situation there in terms of
what we see mostly is smaller businesses or businesses where a lot of the work's outsourced and a majority of the, what's done is by a few partners or things like that. So a small group of select either owners and or employees is where this works best. If it's huge, big company, lots of different people that are going to meet this criteria, the economics might not pencil out as favorable versus the do nothing scenario, if you will. So basically, the less people that are included in the plan, in addition to the owners, starts to decrease the benefit to the owners. So most of the people that work with us are business owners that want to maximize the benefit for themselves. So if it's a single business owner or a husband and wife or a few partners, that's going to work better than if you've got a covered group of 30 employees for whatever reason or more. So the smaller, the better. Small, very highly profitable businesses where there's either a few number of owners and or small group of employees to cover. That's really where this is going to pencil out the best.
Okay. Now talk to me about age, right? Because this is sort of a reverse time value of money strategy, right? Where actually the closer you are to retirement, and obviously maybe you don't want to be too close to retirement because then you're going to be forced to take some out potentially, but you can stash more of this away the closer to the you are to that sort of triggering point. Am I correct in that? Whereas if a younger individual, there's a lot more time for these benefits to accrue. Maybe the contribution's smaller. So does this maybe make sense for business owners that are a little bit higher in age, maybe, not necessarily 35-year-olds, but maybe 50-year-olds or in their late 40s? Do we find that these kind of model out better for those folks?
Yeah. I mean, they model out well in different ways. I think what's important, like the goal most of the time is to maximize the contribution, right? So you can put away higher contributions as you get older, just because you're right. The actuarial value uses life expectancies and things. So as your life expectancy shortens, you can potentially put more away. And that's just a function of getting older. So, that's kind of what you're alluding to there. So yes, it's more favorable to be older in order to be able to maximize the contribution, which is specifically what most of our clients are looking to do. However, one of the caveats of these plans to find benefits are the benefit is kind of stated in the plan. And what happens if the business owner dies tomorrow, right? The proverbial bust. So life insurance is usually included in these plans. As you know, we usually get your group involved for this, right? And the reason for that is because the IRS allows you to put away such high amounts because the plan is insured, because the benefits are solvent, so to speak. And that's a function of the life insurance. So life insurance is included in this overall plan design. And that works against getting older. So the older you are, the less insurable you are, right? And or the higher the cost of that insurance. And so it's a little bit of a balancing act. We need insurance, but we want to make sure it's the lowest cost and it's not really impeding, what we want it to do in the plan. It serves a role, but that's really all we want it to do. And as you get older, you might be uninsurable. You may have pre-existing condition, other stuff that comes into play where you can't do this type of thing. So there's a little bit of a balancing act between insurability and, that kind of a thing versus, it works better as you get older. So it's a little bit of a design function. We go through an iterative process, as you know, where we run the numbers and look at different considerations. And if we're going to recommend this to somebody, we make sure that it pencils out economically with all costs included: administration, upfront setup costs, insurance costs, et cetera. So I can tell you confidently these things do pencil out, but we do go through that process and make that very transparent for clients because there's a lot of moving parts here. But insurability is a key piece to it. And there's a lot of benefits to the insurance in a qualified plan, which we can talk about. But, that is a piece that is competing against age. So it's a little bit of a balancing act.
Yeah, it certainly sounds very, very nuanced, and definitely there's different factors to balance out here. So you got a business owner, they have surplus cash flow that they can then contribute into these plans. They're able to deduct that. So there's tax savings there. Take advantage of, on the personal side of it, a potential tax spread, so to speak. They're going to have a lower tax bracket potentially, or that's what they're maybe assuming, in the long run. And, and obviously this is a way where you can get a lot of contributions into these style plans, pre-tax money. And then then what you're saying is with the life insurance component sort of amplifies that, right? The presence of a life insurance policy within these plans, which is another factor to balance and consider, is going to amplify that and just increase the amount that can be contributed. And as we'll get into, there's some other benefits to having that as well. So to your point, exactly. I mean, like the older the older someone gets, typically the more expensive insurance gets, but also typically their likelihood of being as insurable starts to go down. So there's definitely factors to balance out here.
Yep.
So let's get into that, right? Let's get into some of these factors. We talked about sort of what this strategy is high level. We talked about who it's for and in what ideal circumstances. Let's talk about how this is put into place, right? Talk to me about the process and kind of how we start to design one of these for our clients.
Okay. I think there's 3 phases. So just a headline, I think there's a setup phase, a time when you're getting this thing set up. So I'll talk briefly about that. I think there's a maintenance phase when this thing is in play. And then there's a termination phase. So let me just cover those things quickly for our listeners. Setup is done. It's an actuarial process. So we collect the census, we collect the information on your business financials. The actuaries that we work with will determine what amounts you can contribute. They'll work with you on who the covered group of employees are and what those details amount to, et cetera. And basically we will get a plan that has, 5 or 6 different options. There's different ways to create this and build this based on facts and circumstances. But ultimately, most of our clients end up selecting a plan that allows for the highest contribution levels. And that tends to be one with life insurance. So as part of so we get the plan set up and then we go through an underwriting process for insurance to make sure you're insurable and all that kind of stuff. And so once those things are validated, yes, this works for the business. Here's the group of employees. We can contribute these amounts and I'm insurable. Then we can go ahead and get this thing in place. Okay. Then once it's in place, it's going to be in place for X number of years. So what happens is there's this accruing liability over time, and then the assets are growing. The assets are what you put into the plan and what those grow by. And we got to be a little bit careful because we don't want the assets to get ahead of the liabilities. If you do that, it's called overfunded, and there can be an excise tax that comes into play at termination there. So that's something to be mindful of. It can also reduce the amount that you're able to contribute into the plan. So because our listeners and clients typically want to maximize the contributions, during the maintenance phase, we want to actually get a somewhat muted growth out of the portfolio. So we want to get something like 5 to 10%, call it 7% on average. We don't want to hit home runs with the investments while we're contributing money into the plan, because our goal is really to maximize the contributions, and those two things kind of compete against each other. So I think during the
now, real quick, Sean, to just to interject a question here. So who's helping to manage? So obviously, year over year, there's a certain amount of accrued liabilities or the benefits within the plan, and then we're going to have underlying assets that those contributions are being invested in. So what it sounds like you're saying is we're really trying to target a certain amount of growth to where those underlying assets aren't outpacing those accrued liabilities. Otherwise, there can be some negative implications there. And who's helping us manage, I guess, that process on, year over year? I know that.
So good question. So during that maintenance phase, so all those things in place each year, an investment manager like us, in this case, Centura, will manage the investments. We'll have a mandated return target, risk parameters, and we'll build a portfolio that does that, including the insurance and things. So all of that would be done by an investment manager. And then the actuaries will look at things like the contribution levels of last year, what the assets return, and they'll determine each year what can be contributed from a contribution standpoint. So there's an ongoing kind of dance, if you will, between investment managers, actuary, and you as the business owner to fine tune this thing year over year. And there's probably some meetings in between. But this is a little bit of a high maintenance plan, right? It's not just I'm going to put in 10% of my pay per year and call it a day and invest it in my fund. There's a lot to it, right? So you've got to make enough money and make it worthwhile for that, which is why we're talking about business owners making lots of excess cash flow. But that's what's going to go on year over year. There's a lot of work and administration to make sure this thing is optimized and fine-tuned.
Okay. And so the goal is to put in the maximum contributions many times, right? To max this out. So I'd imagine we almost get to that break-even point quickly, right? Of the accrued liabilities and asset growth. Once we get there, I mean, can there be sort of a contribution holiday many times? And
owners have flexibility. They might have a down year and not want to contribute a lot in one year and then more later and stuff. So, things ebb and flow and all kinds of things. So we typically pick a plan that allows for very high contributions, but there's a corridor, there's a minimum, there's a target, and then there's a max. I think I mentioned that earlier, but they could fund at the minimum in a given year and maybe try to be a little more, growth oriented with the investment. So there's different things that you could do, or you just contribute more the next year, so there's different things like that, but there is some flexibility in that regard.
And then talk to me about, so if we have life insurance as part of this plan, right, to help amplify that contribution, but the presence of the life insurance, it's going to be owned by the plan, correct? The plan's the owner and the plan's the beneficiary? Okay. Yep. And then, the asset growth of that life insurance policy will actually probably lend itself towards that target kind of growth rate, right? Because
it'll be in that area. Yeah, it's going to work as like a bond. It works right in that 5 to 10% return. So we can work with that in the portfolio, no problem.
Perfect. All right, talk to me. Okay, so we have the design phase or the setup phase. We have the maintenance phase. Talk to me about the final phase. What's typically the exit strategy here, and how long are clients typically looking to have these in place? And then what are their options after that?
Yeah, most of our clients are not keeping these things in place all the way in perpetuity to provide the benefits to the stated folks. Usually employees leave, other stuff happens, the business sells. So a lot of our clients are business owners looking to exit. So let's just talk about that scenario. So if you're going to sell the business, the acquiring company typically doesn't want to purchase these plans and these liabilities, if you will. So often these plans get terminated at that point. They get shut down and rolled out to individual IRAs for the different participants. If it's just a business owner, it's just him. But there's other participants, they could set up an account and roll their stated portions there based on their vesting and things. So there's a termination aspect where the plan gets shut down and rolled out as individual assets. And that's where that excise tax can come into play. So if it comes into the fact that the assets are more than the liabilities and it's overfunded, there could be an excise tax there. We've run into engagements where folks come to us and they're going to face an excise tax and they want to find a way out of it or how to solve that or, make that not a detriment to them over time. So there's different ways to do that too, right? It's just about fine tuning the plan and things. So there's different things like that. But if you're going to terminate the plan, generally, we don't want the assets more than the liabilities, which is also why it needs to be managed year over year. And we tend to do it with like a 5 to 10 year window that we're looking forward to in terms of when they're going to sell the business. And so if they do sell the business, that allows them 3-5 years to contribute in plan assets. We make sure that the assets don't get overfunded. And then when they shut the plan down, there's no excise tax. Those assets can roll to an IRA. Okay.
Awesome. And then taking advantage of that potential, tax spread again, obviously. So, they get the advantage of the deduction, the pre-tax money going in, and then it can be rolled out to an individual, qualified plan to which they can then, kind of control the flow of those distributions. And
yeah, exactly. It's not a taxable event. It's just a rollover. So it goes from qualified plan to qualified plan, and then they can invest that with other IRA assets they have or, qualified plan assets they have and use it as future income stream. Something that's important, though, I just want to call out here before we wrap is around the life insurance. So the life insurance, while it actually allows you to put more money in, there's also some permissible sections of code that allow you to take a discount on life insurance. And so that discount can be 20% up to 80% in some cases. We've seen these different large discounts. And what that really means is that as a business owner, you could potentially distribute the life insurance for cents on the dollar, right? Versus just taking the money out of it. So because you mentioned earlier that the life insurance is owned by the qualified plan. So in order to get any monies out of the qualified plan, it's taxable. So if we can get a discounted value on the life insurance, that allows us one of two things, either to distribute the policy at a discount, which is less taxable income than it otherwise would be, or we could also purchase the policy out of the plan with other assets at a discount. And now we own that life insurance policy outside of the qualified plan in your estate, and it can be utilized for different functions that way. So there's a lot of tax benefits. It can even be used for tax-free income after that as part of your portfolio. So life insurance, as you know, has a ton of tax benefits. There's 4 main ones. You can listen to other podcasts that we have on that stuff, but lots of tax benefits around life insurance. And this is one that is solidified in code for many, many years. It's been tested, and this is a longstanding strategy. But being able to discount life insurance and distribute it for cents on the dollar is a very accretive strategy to that tax spread we were kind of talking about. And that really helps the strategy pencil out. So it's really cool. I mean, as a wealth advisor, when you can bring a solution to a client that they haven't heard about, there's maybe 3 to 5, a small group of actuaries in the country who even do this type of work and understand the complexities. Experts like yourself on the insurance side who can actually put this stuff together in a way that is just, overall accretive and minimizes costs and all that stuff. So it's a pretty complicated process. We've, picked up a lot of experience doing this over the years. And I would say that these are really cool ways to save a lot of money for business owners. And there's a lot of benefits there. We barely scratched the surface of it. There's much more to it. We model this all out. We have a lot of math around this, but just understand that as a business owner, if you're looking to put away the maximum amount you can to mitigate your tax today into a qualified plan, then these are the right plans for you. And if you think you're insurable, there's nothing that would prohibit you from getting an insurance offer from a major carrier in this country, then, then you should probably explore this, because I think you're going to be able to find that you're going to be able to put away a lot more money. You're going to be able to save a lot more over time. And when you look at the tax spread that you can create by virtue of life insurance and other parts of the portfolio, it makes a lot of sense. So we do this all the time for clients. We show them how it pencils out, where it works. And I think it's just a great strategy that if you're a business owner with surplus cash flow, you should certainly consider. And I don't think there's a lot of shops doing this. So give us a call. We're happy to walk you through this.
Wow. No, excellent. Very, very well said. I'll just add to that, it's the life insurance piece. It seems, life insurance many times is sold as a Swiss Army knife type of solution. And I think that holds very true here. It might fit the mold here better than in most situations. It's like it allows business owners to increase the contribution, right? Based on certain IRS guidelines. And then once kind of the plan has served its purpose, it allows flexibility to then purchase it out or, distribute in kind out at a discount. And then once that happens, depending on the circumstance, you're able to take tax advantaged, distributions from that policy. So that can be really powerful. Sean, real quick, before we close out, how long does it take to put one of these in place, typically, start to finish?
A few months. I would say, there's time to meet with you, get the information, get you comfortable with it, model it out, go through the actuarial analysis, go through the underwriting process. So 3 to 6 months. It's not an overnight thing, but at the same time, we can get them set up quicker. So a lot of times people come to us at certain times of the year, and it's something we can do. Now, this is one of the strategies you can actually go back in time for. So we can go back to last year and make contributions this year for last year, as long as certain details are met and other things. So it's something that people come to us for, and we can sometimes do retroactively. But it's about getting the business owner comfortable to where they feel confident to make a decision. So I think on average it's maybe 3 to 6 months, but it could be shorter or longer depending on circumstances.
Awesome. Well, hey, look, I think we've we spent enough time on this here. We could obviously probably spend all day talking about these. They're so nuanced, but yeah, no, look, I think this is, as Sean mentioned, a very valuable strategy for business owners in the right circumstance. So with that said, let's close this out. Sean, how can clients or professionals get in contact with you or get in contact with us, if they're interested in these style plans?
Yes, CenturaWealth.com. That has all of our contact information. There'll be this podcast, other podcasts, all that's accessible there. But you can reach us. You can find our contact information on CenturaWealth.com and just reach out to us. They'll get you with the right advisor and everything else. You'll probably end up talking with me and Chris at some point. But, we'll just give us a call and we can look at your facts and circumstances, see if it makes sense to even talk further. If it does, we'll go down that avenue. If it doesn't, we'll let you know what else might work for you. So give us a ring.
Awesome. Sean, always a pleasure. And until next time, thank you very much.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.